Hello and welcome to this edition of the Policybazaar show. Today we are going to talk about perhaps the most important financial product that you need to buy, and that is the term insurance product. It is something that any financial planner will tell you is one of the first things you sit down and get for yourself before you even start investing. Joining me today is Ashish Shrivastav, who's the Managing Director and CEO at PNB MetLife Life Insurance, and Santosh Agarwal, who's the Chief Business Officer, Life Insurance at Policybazaar.com. Thank you both of you for coming by. Ashish, my first question to you. When it comes to term insurance, the big question in everybody's mind is how much insurance do I need and how do I evaluate that? So if you could tell us a little about that.
Sure. No, so thanks Vivek for having me here. I think, first of all, you're right. Insurance needs to be part of the financial planning for everybody. When it comes to the quantum, I think there are 2-3 things. One is, what are your current liabilities, and also what are the future, liabilities, your aspirations, etc. What kind of legacy you would like to, leave behind if there is an eventuality. It also depends on your age, on your income, present income, etc. A rule of thumb is 10 to 15 times your annual income. But I would also strongly suggest that if you want to know more, understand more, you should, of course, look at it online, but can call an advisor to advise you.
Santosh, just to take from there, 10 to 15 times, but is it possible? Because supposing I'm 30 and my income is only going to go up as I get older. So if I were to assess myself on the 10 to 15 times, is it important for me to keep topping it up? Is it possible to keep topping up my term cover as I go along, as my income rises?
That's one thing you could do, or the other thing that you could do, because you would want to lock in lower premiums when you start. When you're 30-year-old, instead of going by the general thumb rule of say 10-15 times, you could, I think 25 times could be the right start for you. Because you are young, you want to take advantage of the lower premium that you get, and when you know that your liability is only going to go up, your income is going to go up, but your liabilities also go up. You will plan a family, you will plan children. So I think when you're a 30-year-old, 25 times could be the right amount. When you become 35, you could go to 20. When you become 40, you could go for 15. And I think when you become 45, you could go for 10. So I think that should be one's approach. And also, if you feel even after taking that amount, if you feel it's not adequate, then top it up. I think that's the right combination.
Santosh, when people decide to go in for term insurance, they look at premium as probably the differentiator, and you aggregate multiple different policies all on your platform. So people tend to look at and say, okay, fine, this is cheaper. Is that the only reason that people should look at the cost of buying the policy? First of all, what is the difference? Is there a big difference, or are they, because it's such a competitive industry, it's pretty much the same premium? And how do you decide to go about choosing the right plan for yourself?
So price is one definitely important factor. And if I would say how much difference is there between the highest and the lowest premiums, there'll be a 40% gap. That's the maximum gap that 40%.
That's a big gap.
That's a big gap. But I think there are far more important details than just price when you determine a life cover, and especially a product as important as term insurance for yourself. And some of those, I would say, is to assess the financial viability of the life insurance company, the credibility, and some of these you can ascertain through a matrix like claim settlement rate. And that's, again, another very important parameter that people consider while buying life insurance cover. And a high claim settlement rate is very, I think, indicative of the fact that the company has been able to pay claims in the past and will definitely continue paying claims in the future. So I think that is one important metric that one needs to keep in mind. The other thing which is important is death the only thing you're securing, or should it be death, disease, and disability? Now, term plans go beyond just covering death. And if the product is able to encompass all these three risk parameters for you, which is also disease and disability, and they can be provided in terms of riders or inclusive features. So that's another wholesome cover that one could buy for themselves. And I think lastly, the other important metric is basically the entire onboarding process, how hassle-free it is, and after you buy a term cover, how smooth can the onboarding process be, because that's also an indicative way of how your claim process is going to be. So I think some of the back end can be tested at the onboarding stage itself. So because when you're not there, you don't mind paying a little extra, but you would want to save all hassles for your family. So that's, again, I think, very important metric. So some of these you should keep in mind.
Ashish, your thoughts on this?
So, I think I agree. You need to look at, the company that you're buying it from, try and find out a bit more in terms of the brand. See, this is a promise that, the company is making to you.
And it's a long-term promise.
And it's a long-term promise. So you also need to see that the family gets the help if that's what it ends up being. And therefore, very important that you look at the brand and the credibility of the company and some matrices and along with that. My view is when you look at these plans, you should also look at disease and disability. Some riders which can help you. Given the incidence rates now, longevity that people are experiencing, I think it's better to have your plan and also have some riders attached to it, as we say.
Can you tell us a little about what these riders are and how they work?
One easy and very simple rider to attach and very, very cost effective is Waiver of Premium. Waiver of Premium comes into effect if you were not able to pay your premiums because of either disability or because of a critical illness. So that's a very cost effective, easy attachable rider. The other riders that you could take is a critical illness rider, which could give you an additional payout over and above the death sum assured if you were to get sick. And this is critical illness mostly critical illness would be like, a heart attack or a cancer, very serious ailments, which may basically mean that you would not be able to go to work. And your income is at risk. So it's loss of income. And how do you cure yourself of that event? So an extra payout there kind of helps. The other bit is, I think, disability, especially accidental deaths we've seen are far too many, especially in younger age groups. Because again, at a very low cost, if death happens because of that, the sum assured can actually be double. So that's again very effective way of securing yourself. So I think covering against disability through accidental death benefit riders, a critical illness rider, a waiver of premium rider, I think these are good enough.
That's a very important point. And if you are around 30 and if you are listening to this show, please remember, for as little as 14,000 rupees a year, you can get a 1 crore life cover. You can get a premium waiver if for some reason you're not able to pay your premiums because of loss of income. You can get a critical illness rider as well as an accidental death benefit as well, all for about 14,000 rupees. How important is it, therefore, Ashish, to buy your policy at a younger age? Because Santosh gave us the 30-year-old numbers. I'm sure if I were to say 40, this figure would go completely up, right? So how important is it? And if you could give us an example of, say, a 30-year-old versus a 40-year-old or a 50-year-old.
So we would suggest that you get, as we said, we started the show by saying this has to be part of the financial plan, and you buy as early as possible, because you start building your liabilities as you take loans, as you take build your house, as you take your own first car or a two-wheeler. Buy it then, because it also helps you keep your premiums at a much lower level. And in most cases, you will find that there are, straight through. So the onboarding experience, you don't have to go for a medical, in most cases, at a certain age, which is, medicals are not required. So our advice is to go for a life insurance policy as early as possible in your life.
And what could be the difference, Santosh, between a 30-year-old and a 40-year-old?
So 40-year-old for a 1 crore cover, could end up costing about 16 to 18,000 rupees.
It's almost double.
Almost double. Yeah.
So if you just delayed by 10 years, you're paying double.
Yeah, almost double. That's right.
So it makes a lot of sense to buy it.
To buy early.
Buy it early. Are you seeing young people, the millennials, coming and sampling and taking a a term cover?
So because we are a digital format, and because digital is mostly accessed by the millennials, so we see a large group of, so the age group that you see in the online format and the offline formats will be very different. For us, the average age of a consumer buying term insurance is 33. But if you take an offline example, that number will be close to 38 or 40. Now, because of the format of distribution, that perhaps is the reason why you see this age gap. But you're right, I think the younger generation or the millennial is waking up to the fact that life insurance or true life insurance is actually term cover. And it's not, the savings format, and it's not endowment plans, or it's not money back plans. That's not life insurance. That's just a way of growing your money. And there are various ways to grow money. Life insurance is obviously one way of doing it. But there are, again, real estate, there's mutual funds, and there's fixed deposits. There are various formats. But that's not what a life insurance company gets a license for. The license is to distribute pure life insurance cover. And I think that's the difference in the generation that you're seeing now. And that's the reason you see that term life insurance was non-existent in India till 2009. And it's really caught up speed in the last 3-4 years. That's, I think, the reason why the sales are really almost doubling every year.
Time for a quick break here on the Policybazaar show. When we come back, Ashish Shrivastav and Santosh Agarwal answer some viewer questions. Welcome back to the Policybazaar show. With me is Santosh Agarwal and Ashish Shrivastav of PNB MetLife Life Insurance. What are limited premium term plans, Ashish? And is it possible for me to do a single premium payout? Sometimes, I might get a bonus and I have some extra money. I may not be able to pay every year. So do I have options where if I have some additional money right now, I can lock myself for the next few years?
So, Santosh was talking about options, and I think, this is one option which is now, also now available, that you can pay for a, particular term and not pay for, if you're taking a cover, for example, of, 99 years, 100 years, there are, plans available, and you don't want to pay throughout. You want to pay till you're earning, life. So you can do that. And so what happens is a lot of people who have disposable income now and can, want to pay the premiums now and cover to last till whatever, 75 years or 80 years or more, can do that. So these are pretty good options now which are available in the market.
What about return of premium? One of the reasons, Santosh, term plans have traditionally not taken off in India is because people think that I don't get any money back, right? We believe that if we are spending on a financial product, we must get something back. Has that changed, or is that still something that once you pay, that's it? It's only going to come to you if something were to happen to you, but not otherwise? I think buying a term plan is important, and even if you were to buy the return of premium option, it's still better than buying a wealth plan. So anybody who's deciding to buy a term plan, whether it's a return of premium option or the basic term option, congratulations for making that decision. Is I think first and most primarily important to say. But I think term return of premium is basically just saying that if nothing were to happen to you, the premium amounts will be returned at maturity. That's not why you're basically buying a term insurance cover. You're basically securing a risk, and if that risk event didn't happen, then ideally nothing should be paid out, and that's the most cost-effective way of securing yourself. But Indians, we do feel that you paid premiums for say 30 years and 40 years and I got back nothing, and that can be surprisingly shocking to a few individuals. And that's why they opt for the return of premium option. That'll cost you roughly about 1 to 1.8 times of your basic life cover. So if you were to pay say 10,000 rupees for a 1 crore cover and you're 30-year-old, you'll end up paying about 18,000 rupees if you take the return of premium option. So there's obviously a cost arbitrage when you opt for that option. But again, like I said, if nothing were to happen to you, your premiums will be returned. So you will not feel that your money has been wasted. It's not a bad option if that appeals to you. And if that's the option that gets you to buy the term life insurance cover, go for it. Ashish also mentioned something around 99 years or 100 years. I mean, can you actually get a cover till you are living till 100 years?
Of course, and Ashish and I think PNB MetLife took the first innovative, I think was the first one to innovate around this, and 99 years is a time you can get a cover for. It's a brilliant plan if you were to buy it for, say, legacy planning, and at the cost that they're offering, the 99-year cover is actually, I think it's a good buy.
So can you tell us a little about this 99-year cover?
Sure. So this is something, as Santosh said, we came in the market, challenging everybody else, saying, this is a cover which gives you, it gets you covered till 99. So, given the life expectancy going up, also some people want to leave a legacy behind. And we said, okay, this is a product which, you can cover yourself still 99 years, and the response has been pretty good.
So at what stage do you stop paying the premiums?
So you can choose to have as we discussed earlier, a limited pay product, or you can continue to pay as if you think that you can continue to pay as your term till the term that you want it. You have the option.
The advantage of that is also that earlier perhaps you couldn't get a term cover if you were, say, 70, but Absolutely. What you're saying is you can be covered till the age of 99.
99, yes.
Wow. Okay, time now for our Myth Buster segment. And the myth we're seeking to bust today is that a term insurance is a waste of money. So, Santosh, we've spent a lot of time talking about the merits of it. You want to sum it all up and tell our viewers why it's not a waste of money?
See, term insurance basically secures your family if you're not around, and their life goes on and is not dependent on your income. And at a very low cost, you can buy yourself peace of mind and your family livelihood. So basically, I feel this is one of the most important when you become financially independent and when you have dependence on you. I think buying a term life insurance cover and buying a health cover should be the first financial decisions one should make. They give you, see, basically for a 1 crore cover, paying 10,000 rupees in a year is almost nothing. So I think it's a wise decision, and you should start as early as possible. Once you get into a job, I think that's the right time, because if you start early, your premiums are very, very low, and premiums in life insurance don't go up. They don't change. Once you enter, say, at 25, and if you end up starting at 8,000 rupees, they'll remain 8,000 till you reach 70, 75. So I think start early, and term and health both are very, very important covers for yourselves.
That's a very important point. You can get locked in at a very early age at a low premium, and that will remain the same till the time your policy is in force. It does not get changed. Unlike other insurance policies of other categories, it does not change every year, and that's an important point to keep in mind. And one more reason why you need to start looking at it early. Ashish, your thoughts on the myth? We keep talking about, we buy insurance for our car, for our two-wheeler, and we pay every year because it's mandated in some sense. I think we should absolutely start early, look at, have insurance as definitely one part of the financial plan, and lock yourself in at a premium which is low and gives you peace of mind as you go through your life. All right, time to take a few questions from our viewers, and the first question is, I'm 32 years old and have a 1 crore rupee simple term plan without any rider. I am planning to get another 50 lakh to 1 crore with critical illness and accidental disability. Based on my current income, insurers are suggesting me to get a 2 crore policy. I want to ask, do I need more insurance cover? Do I need critical illness and accidental disability coverage too? If yes, what should it be like? Does it make sense to go with a one-time premium? Are critical illness and accidental disability also part of medical insurance? With which insurance should I get them, medical insurance or term insurance? Should I get my critical illness rider through a health insurance company or a term insurance plan, I think is his question, but lots of questions there. Yeah. Can you guide him through what he should do?
So whether he needs, cover beyond what is already bought, it will depend on his age. He's pretty young. You said he is 32-year-old, if I'm not wrong. Yeah. So I think at 32, you should take at least 25 to 30 times, I would say, your income. So he should, assess if whatever his income is today, if the cover amount is 25-30 times, then he's sufficiently covered. That will take care of his income as it goes up. That will take care of the liabilities as they go up, because he will plan a family, he will plan buying a house, etc. So I think if he feels that 1 crore is not 25 times, then please go for an additional cover, and starting early will give you the benefit of lower premiums. The second part of the question, whether you should buy a critical illness cover through term insurance, basically through life insurance, or through, health insurance is the second question that he is asking. See, health insurance is basically an indemnity cover, which will cover you if you were to get hospitalized for any reason. But health insurance generally will give you a cover amount of, say, 5 lakh, 10 lakh rupees. Critical illness, on the other side, are events which are far severe in nature, and the costs associated with critical illness may be much higher. For example, if one has got cancer, the cost of curing cancer will run in a few lakhs and not just and may not be covered by a health insurance cover. So what happens with critical illness is that these are meant for very severe events, diseases, and give you large covers which your health insurance may not be able to cover you for. So buying critical illness is, I think, a good option. One should consider a critical illness rider which covers you through all stages. What is important is please buy a critical illness rider that covers you at all stages of the disease and not just the final stage. That's one thing you should look out for when you buy the critical illness rider. The other bit is the accidental death benefit rider. I think that's important. That will cover you for more payout because of accident, and it also covers you for disability. If basically something were to happen to you and you were not able to fend for your family or basically go to work, it will give you a waiver of premium, which will basically mean your term plan will go on, and it can also give you some payout to basically take care of yourself during that time. So I think both of these riders are important. They cover you, so the plan that you buy becomes a wholesome plan. It covers you for death, disability, and disease.
Here's a question coming in from Pratyush. He's from New Delhi. He's 33 years old, and his question is, I'm looking to buy a term plan, and at this stage my fitness level is good. I wanted to know if it's a good idea to skip the medical checkup when buying term insurance. Ashish.
So, Pratyush, I think, he's young right now. As I mentioned before, there are, a lot of insurance companies now who will offer him a product with almost no medicals. In some cases, straight through, no medicals. You need to tick the boxes, some boxes. In some cases, there may be a telemedical, which companies have introduced for ease of customer onboarding. I think at that age, he should be able to get a good cover with no or as I said, telemedicals.
Okay. That's all the time we have in this edition of the Policybazaar show. Thank you very much, Ashish, and thank you, Santosh, for coming by and sharing your thoughts with our viewers. If you too have a question, you can write into us at policybazaarshow@policybazar.com. We'll be back next week with lots more information around insurance. Keep watching.